We are delighted to welcome to Moneycontrol a true legend of Indian banking and a serial creator of institutions, KV Kamath. Mr. Kamath shepherded ICICI's transformation and eventual merger into ICICI Bank early in this century. He stepped down from his executive position in 2009 and was the bank's chairman till 2015. He was also chairman of Infosys for 4 years between 2011 and 2015. The storied software company was undergoing a complex transition of its own during that time. He was clearly not done with institution building. He was appointed the first president of the Shanghai-based New Development Bank, often referred to as the BRICS Bank, in 2015, from where he retired in 2020. In the last 5 years, he has helmed two institutions, the newly created National Bank for Infrastructure Financing, of which he was chairman till late last month. He is currently also chairman and independent director of Geo Financial Services. Mr. Kamath, welcome to Moneycontrol. We are honored to have you here. So we are meeting on the day before the US elections. So there's a lot of data which the markets are waiting for. There's the US elections. There is the expected Fed rate cut. How the Fed reacts. There's the big China stimulus which was announced some weeks back, and there's another stimulus package being discussed. So where does India fit into all this? Does India continue to be the bright spot in the global economy?
As I said, there is actually no other economy which is currently probably doing as well as India is. And if I look ahead, probably I will find it difficult to find any other economy, because the sheer fact that we have a long runway for growth, and that runway is could stretch to 25 years, but certainly for the next 15 to 20 years, we have so much to do. And so I think we are going to be economically important for everybody else around the world.
How much should Indian investors care about what's happening in the US market? Who's becoming the next US president, US Treasury bond deals? How much does all this really matter?
Yeah, I think what we probably need to look at on an ongoing basis is any event globally, what sort of volatility does it create for us, and how well are we prepared in a way to handle that volatility. Now, we have seen over the last 2 years one incident in Europe and the second one in the Middle East, and the volatility that created. And I think we have understood how to bear these shocks and get on. Yeah, there was inflation and we managed it pretty well. So we continue to ride it out. And I think going forward, this is probably going to be the norm in the economic context.
So you see increased volatility perhaps for some reason going forward also?
I don't see anything that will stop it all of a sudden. And if there have been two spots where it suddenly came to the surface, I wonder whether there are more spots which we are not recognized. So a good strategic thought could be to prepare ourselves for this sort of volatility going forward.
Mr. Kamath, you've been an observer of Chinese economy, and of course for 5 years you were the founder president of the New Development Bank, often referred to as the BRICS Bank, one of the many institutions that you have created. What is the significance of the Chinese stimulus as far as the Indian economy is concerned?
Yeah, I think from a purely external perspective, because I am no longer now in China, one I think is for their own the economy itself, to make sure that it gets back to it's a pump priming to get back to the growth rates that probably for an economy of this size, 18 trillion plus, is required. That's probably the first one. Second, probably the reason could be that the whole context of changes happening at a global level, and the importance of various currencies. This could be a step to strengthen the economy at a time when things are, one needs to look at what is happening elsewhere in the world. And this could be the step to make sure that they are in the right economic situation to look at anything that is likely to happen.
So in this context, how do you think the Reserve Bank should react? Should they be thinking about cutting interest rates?
Firstly, I think Reserve Bank has managed the economy I would say beyond a textbook case of management. It is extraordinarily well managed between the government and the Reserve Bank right from the time of COVID. Not doing anything knee-jerk, being very supportive, holding rates, cutting rates, every single step taken the right way. At this point in time, given the uncertainty, as you said, in several domains, I think a nagging feeling that we need to see inflation really behave before we take a step which could then require again addressing the issue. I think they are probably taking the right step in being watchful.
So coming to some of the things which have been referred to as possibly areas of concern, private capex still remains patchy. I mean, some of the big industrial groups are investing, the top 2 or 3 or top 2 or 3 or 4, but beyond that it sort of remains patchy. Capacity utilization is going up. What would it take to revive the much awaited private capex, and because the government capex has been taking up the slack, but I think now this year it is kind of seems to be tapering off.
Private capex, if I look at manufacturing, because there will be one key area. I think infrastructure will happen. There were the well-known issues. I think those were addressed. Infrastructure investment will happen. But private capex in manufacturing is a function of 2 or 3 things. One is the most critical thing is how long does it take you to add incremental capacity? So when I started my career, a greenfield project was 5 to 6 years, and what we call modernization, and it was about 2.5 years. Today, a greenfield project is probably 2.5 years, and just a balancing modernization project is probably less than a year. So companies can time capacity increase to what is happening in the actual market, and I would think at this point of time they are sitting on capacity which is still to be utilized. The other point that I believe which is not probably been talked about is that during COVID, Indian companies managed to increase productivity rather dramatically because they had no other option. Your workforce went home and you had to produce, and within 6 months you got back to 100, but only 75% of your workforce came back. So how did this magic happen? It happened through productivity increase, through process change, automation, and so on. So I think that capacity is still probably there, and they have now also figured out there are other ways in which we could increase our output by not necessarily investing in a large way, but investing in a meaningful way in automation and other routes. So to me, I am not worried about that not happening. Second reason could be that there was an early indicator earlier available to us, which was drawdown from a bank loans. But now, since last 2-3 years, cash accruals have been so healthy, and corporates are actually completely deleveraged. They're now using those cash accruals for investing into new capacity additions, and that's not coming out as quickly as, say, a bank drawdown would have come, because the bank drawdown would have been in the numbers next quarter itself. But here it probably takes time to track the balance sheet, because you will find that increase only happening through either addition to gross fixed assets or capital work in progress.
Just before I turn it over to Hamsini, our banking editor, for a few, I just want to ask you one, and I also just link it to China Plus One. India is seen as a beneficiary of China Plus One. Multinationals are looking for an alternative supply chain, strong supply chain partner. But while that may well be the case, and there's a lot of anecdotal evidence, there's obviously the iPhone production out of India, some anecdotal evidence, but at the aggregate level, FDI has actually been negative this year, right? And a lot of the FDI which seems to be happening is actually private equity companies buying from each other. What are your thoughts on all this?
Yeah, I would probably think there are 2 things happening here. I think FDI coming in would be for 2 reasons. One is people investing see an opportunity in India, right, and or they see an opportunity abroad. Now, for the reasons that we mentioned earlier, opportunity in India, if we have still got idle capacity, I think they're probably holding their investment proposal for a time when capacity is up and fully utilized. For exports, I think it's a slower cycle. You cannot suddenly change from wherever you are getting your supply or your supply chains to a new destination. And in India, probably given the vastness of our country, for a foreign to set it up as a +1, we need to look at the logistics of supply. Probably that also is creating a slight lag in that capacity coming up.
Right.
Yeah, thank you. You touched upon earlier about how RBI has very nicely handled inflation and all, but there's also a case sort of getting built, especially from some of the large industrial houses, in favor of a rate cut. What would your take on this be? Are we there yet at a juncture where we can say softer rates would help in private capex? RBI seems to be having a slightly different view on this though.
I think softer rates always help. But I will quote a legendary professor of mine who was later on the Reserve Bank governor. And when I took over ICICI as CEO, took over as CEO in ICICI, this is 1996 or so, interest rates are 16 or 18%, our lending rate. So I went to my professor just to reintroduce myself, and he very sweetly, and I talked to him about interest rates. He very sweetly told me that I have to be responsible to the people, and I am sure that every successive RBI governor would say the same thing. They are responsible to a much larger audience than say a set of industry leaders would be. So they have to weigh all things and then do what is right, and I sincerely believe that they are doing what is right, and truly believe they are doing the right thing, and over the time, but particularly through last 4 years difficult period.
Before we delve into more of banking related topics, payments is beginning to become the new oil for the banking sector. There's a lot of interest internationally and domestically in being actively involved in the payment space. How do you see this evolve? And our own NPCI has given out UPI to other countries, which is probably happening for the first time, reverse technology share. How do you see this whole payment space evolve for us?
I think the whole payment space in India, the metamorphosis in the last 4 years, started with, in a way, COVID, and accelerated post, even as COVID was raging. Thing is remarkable. It only shows to me that innovation is still possible, and we could innovate in a whole set of areas beyond financial services in other areas. But your question was specifically payments. So payments, I think, will show the way to a lot of other things that the digital economy could do for India. And that process, I think, is already on us. I remember when we started banking, at least I started commercial banking and about 25 years back, we were looking at how do you go straight through. Today everything is straight through, and the next level will be how do you make that straight through on your device. And that also is happening. With UPI it has happened. So the next level will be to see how do you take the learnings from UPI and overlay it on other areas of operation, not just in banking but in the financial services business. And this is where the new fintechs come into play. They are the innovators, and I think the incumbent players, the slightly, I would say, older players, I don't want to use the word legacy, will have to learn from the fintech players to drive this forward. And the opportunity is not just India. The opportunity is also to, in a way, communicate to the external world that things are happening here which have a lot of significance and importance to other countries around the world, whether they are developed or developing, and all this will be to common good.
Fair point. Let's get into some of the micro aspects about banking. Overall health of the banking industry has been stable and in a picture which has never been the same before. But there are some concern spots emerging in the retail side. We saw credit cards show some bit of delinquencies, elevated delinquencies. There's a trouble coming in from microfinance as well in the last 2 quarters. Do you see these two pockets pretty much sort of rocking the ship for banks right now? Because 60% of the loans across most banks, whether PSU, private, are all aligned to retail this juncture.
Yeah, I think it would be right to say that there is a challenge on 3 fronts. The third front is unsecured personal loans. And we'll have to look at what exactly is an unsecured loan. I would think that an asset which is not possessable or repossessable by a bank is also an unsecured loan. So if you add that to the two that you mentioned, then I think a good part of that 60% exposure that financial institution has, a bank or a financial institution has, could be at risk. I'm not saying it is at risk. And I think that's one reason why the Reserve Bank is cautious, and that's one reason why the governor has been very open and increasingly open. And if you look at in the last commentary that he made, cautioned the banks to take care, and I fully agree with him. There is caution required, and we need to have an understanding as to where did this money get spent to create the NPA problem that you have, and did it go into what sort of activities did it go into, and then try to be on top of that situation. So a red flag has been raised. I hope the banks take note of it, because that's for their own good and their own health.
Perfect. On that note, there is quite a lot of conversation about the way the Reserve Bank has also sort of been clamping down on some of the ill practices or some of the banks and NBFCs in the way that they've been operating. Banning businesses is the phrase that most banks are attributing to this practice. In a way, it has forced people to relook at their strategies, rehaul wherever there were deficiencies. But in your view, is this the right way to go about ensuring that bad practices are completely taken out of the system?
Yeah, without going into specifics of what could have driven this, let me say that a regulator certainly has to tighten where it sees that there are practices which are not appropriate or where they are lax. And it could be both in this case. And it's better to clamp down now and make sure that the counterparty has course corrected before proceeding, and the signaling impact of this to others who may be down that path or were thinking of going down that path, I think has to be made, and that I'm sure will prevent problems going into the future.
I guess the question she was asking was that has the RBI been too harsh?
No. I will be very clear, no, because they would have taken steps only when they realize that the situation on the ground warrants this sort of an action.
But can the RBI consider heavy penalties instead of an outright ban on business? Penalties is a practice.
My own assessment here is, again, I do not know what the cause is, but what I can probably think through is there was something that needed to be fixed. Because in some instances it was technology. So if technology was needed to be fixed, that technology fixing takes time, and the regulator wants to make sure that the technology is indeed fixed before allowing it to proceed further. And I'm sure there would have been instances where penalties were imposed, but probably there was a need for something more than penalties, and that's why the action.
As much as the fintech sector has seen in the last 4 years a lot of $1 billion flowing in, although in the last 1 year or so it has tapered a bit, the banking sector hasn't had a big ticket fundraise since possibly 2017 or 2019. Does this concern you?
I think the last one was Axis Bank.
Yeah, but I think it's a good question. It's an excellent question, because I think this needs to be put in perspective. If a bank is ROE is between 15 and 20%. You are a perpetual cash or an equity generating machine, so you don't need outside access. Right. See, when you are a 10 or 12% ROE institution, then if you want to aspire to grow at 15% or 18%, not more than that, that could be dangerous. You have to make up that gap somewhere. But if you are generating nearly a 20% ROE, then you have got all the capital that you need to grow. If it is below that threshold. And so these have become now, I call themselves perpetual equity generating engines. They're good banks.
Lovely. What about on divestment? Because that's again a pocket where we've seen a lot of talks happening, especially around 2020. IDBI is a case which is walking the path of divestment possibly for the last 4 years, we're not seeing a closure there. And there is also often a talk that there could be more divestment candidates. You've been a advocator that government should not be in the business of running banks. Private banks handle it more efficiently. What's your take on that?
No, I think this is a call that the government has to take, and that is why there would have been thought behind the government taking this decision to divest. There again, I think we need to look at what could be the need for divestment. Typically, the need for divestment arises from large capital needs. But now, if these banks are self-sufficient in capital, you then have to ask a question: why do I need to divest? That's point number one. The second point is that the sort of reach the public sector banks provide, the private sector banks do not provide that reach. So that reach, I think we need to make sure that is there. Third and most important point, I think, is over the last few years, a catch-up has happened on technology. So I do not think that today technology of a private sector bank is differentiated at all from what a public sector bank uses. So that could have been a reason earlier on you could run things differently and straight through, but now everybody runs it the same way. So the case for divestment or I think is now getting to me a little grey in terms of what banks need to do. So the government will take a call. But in the banking sector as a whole, I firmly believe there is a case for complete revamp of technology. Because what technology the fintechs and the new players are building in can very easily be put into a bank and make that bank significantly more efficient. And I think that will happen over the next few years.
But why hasn't that happened?
See, I would put a simple reason to it. It's a matter of courage. Any technology change is a courageous decision, and it has to be done with a great degree of courage and caution. So I think it will happen as we go along.
So to go back to Hamsini's earlier question on payments, do you think even the big private sector banks who have been leaders in many other areas, they missed the bus on payments and allowed GPay or a PhonePe to build up, or even a Paytm to build up huge market share? Is that a bus that they missed?
Yeah, I think this again I would lay down to the innovation ability of different players. The fintech digitech equation there, they are definitely more nimble in terms of identifying technology opportunities and then leveraging those opportunities, and that is what has happened. So the banks are playing a catch-up game there, but incumbent players are fairly deeply entrenched.
Right. Sometimes the fintechs are a bit too much on the edge, perhaps, but
yeah, innovation always means that you have to be at an edge, and when you are in the financial services space, you will survive and succeed only if you recognize where that boundary line is and make sure that you don't cross it or don't slip across it.
Deposits has been a thorny area for banks, possibly ever since the rate hike started from May 2022. It picked a pace towards the end of that fiscal, and now the system seems to be sort of over focusing on this whole concept of having an equitable credit deposit ratio. We are always a deposit dependent banking system, but now the reliance on deposit seems to have increased a lot more than what it was about 5-10 years ago. What's your take on this? Is this a healthy habit in the long run?
I think it's a very healthy habit in the sense that the CD ratio has to be well modulated and well moderated, and I think that's what the regulator is saying. So I'm fully in sync with that as a banker. So it has to be. I would think deposit pickup is also at times there are so many factors at play, and in the near term, if you now look at the government spending numbers, I think that would need to come in to get the deposit numbers right. So I wouldn't be too worried about it. If the bank is still growing at 15-16%, and then I think we are okay. Anything beyond that is dangerous.
So earlier this year there were some concerns raised about people, to put it in simple terms, people not putting money in bank deposits because of SIPs, or they were investing in mutual funds or even in FNO and all that. There were some remarks by even the top policymakers which seem to suggest some concern in these areas. What are your thoughts?
Yeah, my thing is ultimately banking is largely a business which is in equilibrium. So if money goes somewhere else, it has to flow back somewhere unless it is trapped as cash outside the banking system. I don't think we see that, so it will flow in. To me, it is basically the incremental flow that would have come from government expenditure, and that probably slowdown is what has happened. Other than that, I think it is not something that I would be worried about.
Right.
I'll come to the most interesting part of banking from a regulatory perspective, that on licenses. Today we have at least 3 NBFCs which by size are much larger than some of the smaller private banks. Gradually, are we making a case for NBFCs to become banks? Is there also a case being built up for the government and the regulator to relook at where we stand on who should be a bank, who should operate as a bank?
Yeah, I think if I look at it, the lines between differentiating banks and NBFCs, the Reserve Bank in a way is, to me the message is very clear. You have to behave like a bank, and that is the behavior that I expect from you as an NBFC. That statement I think the Reserve Bank is very clearly making. So I think all incumbents now are supervised to that level. Now the next step on whether they should be banks or not is something that is a policy decision. So one would need to wait for it. I would have been more concerned if the central bank is not regulating you to be almost like a bank, but that already is been done. So I think the next thing is when the policy decision is taken, that probably will tell us what the direction is.
The criticism on the flip side is also that some of the new licenses that were handed out, new segments of licenses that were handed out, like a payments bank or a small finance bank, we're almost 10 years through the cycle. None of them have come to a stage of maturity. If any, that it talks about consolidation happening in this space. Do you concur with the view that these licenses probably were not thought through too well from a long-term sustainability perspective?
Actually, my view is that they were thought through very well from a long-term sustainability perspective at that point in time. But what has happened between say 10, 12 years back and today is that the playing conditions, particularly the technological structure, has completely changed. And the UPI is one example. So your ability to reach N as a number, as an individual somewhere in India, today is much better with UPI than it was earlier. So some of these banking structures probably have been overtaken by technology developments, and I'm sure that must be in the consideration of the Reserve Bank to look at how we address an India which is transforming and a technology landscape which is transforming.
Yeah. They have in fact come out with a roadmap to allow small finance banks to become universal banks, so that might be. I just wanted to come to a couple of other issues. So you've in the course of your long career, you've built many institutions, including one in China. You've been associated with 2 institutions, one till very recently, one in the public sector, also chairman of leading NBFC. How has the experience been? What I'm saying is the recent institution building, the NABFed or Geo Financial, how has that experience been for you as an individual?
I think
the first one was a public sector institution also.
It's for me, every institution that I've built has been a learning experience. And this is no different. And if I will spend half a minute on BRICS Bank. BRICS Bank was an exercise in learning cultures and how to work with the different cultures while building a bank. And my key take from that bank was that countries of the South, when they get together, they are much stronger than on their own. The fact that the BRICS Bank had a AA+ rating, and which meant that there was no differentiation in pricing when I raised money from the global markets. Whereas individually, say in India is a BBB-, and there was only one country which was A, and others were all BBB- or below. So, but when you collectively got there, we had that's a huge learning. That's the strength of the South came out very clearly. I think the other 2 institutions have been very interesting experiences. where you could build teams from the available leadership in the country, whether private sector or public sector, and build them at great speed and get them to be very successful. And again, in a way that is fit for purpose, because we were talking about, people were always asking me, why is it that ICICI and others had to close down? Because the flow of funding for these institutions was no longer there in the 90s. It stopped. So you had to course correct and become something else. Now with the flow of funding coming in from pension and insurance monies, long-term funding in ample measure, and there being infrastructure is the key growth sector, the sunrise sector for the next few at least 10 to 15 years. So you have institutions which are fit for purpose. So it has been very enjoyable and a huge learning that things change, and we have a broad area of leadership available which can be very quickly marshaled for great good. Both these institutions have been a great learning experience.
So, if I can just take off from one of these points which you made. So, in some ways NAPFID is in the 1990s, I mean IDBI, ICICI or even the old IFCI used to be called development financial institutions, and they were largely financing infrastructure. In fact, you were famously associated in the 2000s with the shift to retail when you were heading ICICI Bank. In a way, it's kind of back to the future, right? With
yes, and I think it is back to the future, and it is to the government's credit that they realized that we need a back to the future institution to be created, and given what is happening to our growth story, and that infrastructure is going to be the main driver, and we needed an institution to put that on the map, as it were, the infrastructure growth story on the map. And that, I think, will accelerate as we go along. Indeed, yes.
How does NAPFID avoid the problems which afflicted IDBI and ICICI?
Because so what was the challenge of ICICI? We raised funding on the back of a government guarantee from banks. Right. And the banks basically have 1 year tenor money. Yeah. And we were trying to deploy it for 7 to 10 years. The government then said, we have other need for bank money, so we are not going to give it to you. And that's how we had to course correct. Now we have a situation where, as I was saying, you have pension money, you have insurance money in ample measure, and you are now becoming the intermediary to marshal that money and then pass it on to infrastructure. So what could not have been done by an IDBI or an ICICI, an IFCI in the funding side, I think today's long-term lending institutions, say NAPFID, can do. And it was, I think, fit for purpose, fit in the context of time.
Why can't the private banks or an SBI or a Bank of Baroda also compete in this
Again,
this sector?
You will have to fund yourself differently. You will have to be prepared to take risks differently. And then you're, in a way, mixing two books, a short-term book with a tenor of 1 year with a long-term approach. And you will end up, and it was probably happening, tenor mismatches which were going to be there. You take 1 year money and try to deploy it over 10 years and say, I'm going to reset it every year. Then in between, because these are demand deposits or 1 year fixed deposits, the flow of deposits doesn't happen, what happens? So you have consequences which need to be thought through, and I think that is now getting corrected.
So thank you, Mr. Kamath. I think we've reached the end.
Thank you. And let me compliment Moneycontrol on all the progress. I think I heard that you crossed 1 million subscribers, and I can say that I am a user of Moneycontrol. I find it my go-to channel. I mean, not that you are here today, but my go-to site for whatever I want in terms of analytics, whether it's balance sheet analysis, ratio analysis, or the 4,000 plus companies that you report on a quarterly basis. I go there, I get what I want to understand, and that suffices.
Thank you so much.
Thank you
so much.